We have been talking about the principles, the basic principles of financial management. We said that there are three very important principles that guides any business entity: the investment principle, financing principle, and the dividend principle. We looked at this in greater detail in the last sessions. So for example, for the financing principle, we said that investment can be either mutually exclusive or independent. A mutually independent, I'm sorry about that. Let me just choose a different color. Okay. Sorry. So for mutually exclusive projects, we said that the company has to choose. It didn't change color. Okay, sorry about that, guys. Okay. We said that for mutually exclusive, the choice of one among these, for example, among A, B, C, D, will mean we're rejecting the others. So you're just choosing one, and that's what we call mutually exclusive projects. And the choice, of course, is dependent on whether the project has an NPV, net present value, greater than 0, or an IRR greater than the weighted average cost of capital. Okay, this is very important, guys, because any decision that the company has should maximize shareholder value, and it can only be attained if these principles are met. Net present value greater than 0, IRR greater than the weighted average cost of capital. And how was the weighted average cost of capital computed? We showed the formula last time. Okay, it takes into account the cost of debt, the cost of common stock, and the cost of preferred stock. The cost of debt, we noted, was adjusted for the tax rate, because we said using debt provides a company with leverage, so the cost of debt is reduced by the tax rate. So if tax rate is 30%, then that means the weighted cost of debt will only be 70%, okay, of its weight. Compare that with the cost of equity, common stock, and cost of preferred stock, where we don't have tax deduction, tax savings out of that. So that takes care of our investment decision making. For the financing decision making, we said that a company has to determine its optimal capital structure. Okay, should it be 40-60, 70-30? Okay, should it be 30-70? Whatever this optimal capital structure is, we said that the goal is to maximize shareholder value. Any capital structure that does not maximize shareholder value is not the optimal one. Okay, so we said that there is no one uniform optimal capital structure for a firm. On the other hand, usually for industries, they can come up with an average WACC. Okay, if you belong to a particular industry, then more or less, you'll have the players there will have approximately close to each other weighted average cost of capitals. That's why there are some companies that do come up with average WACC computation for specific industries. Okay, then we talked about dividends. Okay, we said that it's important that companies must decide whether, if there's excess cash, whether they return it to the shareholders in the form of dividends or they plow it back to operations. That's a very important decision. In fact, dividends could be one of the most important decisions that a company should engage in. Okay, because we know that there's an advantage also of returning excess cash to shareholders in the form of dividends, because this sends a strong signal to the industry, to the market, that the firm is able to generate future cash flows. Okay, that the firm is performing well, so it's able to generate cash flows that are distributed back to to their shareholders. Okay. On the other hand, it could mean also that there's a lack yet of investment opportunities. So it might as well return the excess cash to shareholders for them to be able to use that for their personal means, for let's say investing in a project which they feel they can benefit in. Okay, so let's review this quickly. So for the first principle, guys, let's briefly review this. So the objective is to determine in which businesses should the company post its resources. Where will they invest in? Is this a particularly good industry to invest in? Okay, or is this equipment? If we're talking of the mother company, the mother company will decide in which industries the firm will invest in. If it's a strategic unit, maybe is this a good equipment to invest in? Is this a good technology to invest in? So whatever the level of decision making, whether it's the mother company or the SBU, the decision rule is that the firm should invest in assets or projects where the return, whether it's the IRR or the NPV, should be greater than the minimum acceptable hurdle rate. So in particular, this will refer to the IRR greater than the weighted average cost of capital, which is also corollarily the net present value should be greater than 0. Okay, and we know, guys, that the hurdle rate should involve the financing mix. So it should also include the debt, okay, and it should also include equity. So the WACC should be a combination of this. That's why it's called weighted average cost of capital, because the cost of capital comes from not only shareholders but also creditors. Okay, so just a moment, guys. Okay, so as we were saying, guys, when we determine whether an investment is okay or not, okay, the return should be greater than the hurdle rate. Okay, also the hurdle rate should include all sources of financing like debt and equity, whether it's common stock or preferred stock. Okay, and then the return should be based on a computation of cash flows. Okay, we don't use the profit to determine whether a project is feasible or not. We use cash flows. And not only do we look at the magnitude, the amount of the cash flows, we also look at the timing of the cash flows. We'll discuss this in greater detail later. Okay, so this is very important. When we determine whether the project is feasible or not, we base it on the cash flows that will be generated by the project. Okay, now how about financing principle? When we talk of financing principle, we are looking at the financing mix, the mix of debt and equity that maximizes the shareholders' value. Okay, and not only do we look at the financing mix, okay, it should be the right mix, and it should be the right match. So it should be the proper mix and match. Now, what do we mean by match? When we talk of matching, guys, we're saying that the project, long-term project, should be financed by long-term financing. Okay, let me repeat that. If the project is long-term, okay, the financing should also be long-term. There should be matching. Okay, we do not, guys, for example, the project has a cost of 500 million, 500 million, that's for 10 years. Okay, we do not finance this by a 1-year financing. Okay, finance dictates that a long-term project like this should be financed by long-term financing, long-term borrowing. Okay, it's a big blunder for finance to do that. Imagine using the credit card to buy, let's say, a land worth 500 million, credit card payable in next month. No, that will be something that's very stupid. No, a long-term project should be financed by long-term financing. On the other hand, a short-term project, let's say that will mature, long or short-term asset that will be useful only for 3 months, you don't borrow funds that's payable in 20 years for that. So that's also wrong. So it's important to have the right mix of debt and equity in the capital structure and the right matching for specific projects the company will engage in, will involve in. Okay, let me pause for a while, guys. Clear to? Yung right mix at saka right match, guys, is that clear? Would you kindly chat, please? Okay, thank you. Right mix and right match. Okay. Okay, then this is what I think I mentioned this also before. It's important that finance makes sure that there's a constant inflow of capital. Okay, so an operation, guys, cannot manage to, it's not sustainable if there's no support of additional liquidity. Case in point, whether it's OPEX or CAPEX. OPEX, for example, a firm needs to have a steady supply of financing or liquidity in order for it to generate more revenues through sales. And this is important. This can only be done if the company has financing for its let's inventory, for example. A firm that's not able to purchase raw materials anymore will not be able to, of course, have finished product and sell. So for sustainability, guys, it's important that finance ensures that there's a constant inflow of capital. Okay, so whether it's a short-term asset or a long-term asset, it's very important that the firm is able to provide the additional liquidity. Okay, that's for financing. For the dividend, guys, this can be one of the most important financial decisions that a manager has to make. So we know that it concerns the question, how much should we return or pay out to shareholders? How much should we reinvest in the company to improve operations? So this is a critical question. So we know that, for example, if in the net income after tax, okay, either this is flowed back to operations in the form of, do you call this, guys? What's RE? Anyone?
Real assets, sir.
Real assets, okay. RE, RE. RE, this is flowed back to the business. No? Flowed back to operations. This is, thank you for that answer. Who's that?
Concepcion, sir. Gabe.
First name?
Gabe.
Gabe, thank you.
Sir,
But, yes?
retained earnings po.
Yeah, thank you. Who's that, please?
Patricia po.
Patricia, thank you. You're correct. This is retained earnings. No? So this is the cash flow, guys, flowed back to operations. On the other hand, this is your dividends. So a company has to determine what will be the dividend payout ratio. Dividend payout ratio, which is how much of the bottom line should be flowed back to operations, how much should be distributed to dividends. And that's a very tricky decision that the company has to engage in. And that's within the purview of finance. It's not the role of marketing or accounting. That's the role of finance. Okay. So just again, to look at this, Pag wala namang enough, if there are no investments that the company can go into, it's best to return the cash to the owners of the business. Okay? In the case of publicly traded firms, the returns, whether it's dividends or stock buybacks, when you say stock buybacks, the company buys back the share of the owners. Okay, it will depend on what stockholders prefer. Okay, now, will shareholders be happy if there are no dividends? It depends on the situation, guys. Usually there's a stockholders meeting and the management will give a report to shareholders. And if there are new possible projects, they will inform the shareholders that there's the company will be investing in this such and such. And the return of that, the estimated return is, let's say, 30%, for example. I'm sure shareholders will not mind not receiving any dividends. Okay, because they know that their let's say equity, their stake in the organization will improve because of that possible investment. Okay, unless they have something, they have this opportunity to invest in something. In that case, they will sell their shares, okay, and invest in that. That's very simple, actually. And it's really up to shareholders, especially in a publicly traded firm. So the shareholders have the option to sell their shares to the market, to the Philippine Stock Exchange. Okay, so in a nutshell, guys, when we talk of corporate finance, it really boils down to this financing, investing, financing, and dividend decision. Okay. At its core is, how do they manage these funds? When you say management of funds, how do they use it and where do they get it? Okay, how do they use it, which is investing, and where do they get it, which is financing? Okay, and then how do they manage it in such a way that it should provide returns that are greater than the hurdle rate, and it should be able to maximize the shareholder value. And then when we think about the dividend distribution model decision, how much of this should be reinvested or flowed back to operations, and how much should be distributed back to shareholders? So this is, in a nutshell, guys, are the core principles of corporate finance. Managing the employment of funds. Again, when we say manage the employment, okay, when we talk about employment of these funds, we are necessarily employment of these funds. We're not necessarily talking about the acquisition. Acquisition, getting the funds. Okay, getting the funds, which is financing, and also using, which is investing. Okay, and then also is the decision whether to return cash flow, excess cash flow, to shareholders or to flow it back to operations. Okay, so this is a very beautiful summary of what is really the main function, the core corporate finance principles. Okay, so let's just expound on that a bit. The objective, whether it's investment, financing, or dividend, is to maximize the value of the term. When we talk of investing decision, again, guys, we want to invest in assets. We want to invest in assets. Okay. Assets, where the return should be greater than the weighted average cost of capital. Okay. Now, and some very important aspects here. The hurdle rate, the WACC, should reflect the riskiness of the investment. Okay, riskiness of the investment. Why is that so, guys? Because when we compute for the WACC, we know that the formula is the weighted cost. And we know that this is the weight of debt, cost of debt, times 1 minus tax, plus the weight of the common stock, cost of the common stock, plus the weight of the preferred times cost of the preferred stock. Okay, so it involves the riskiness of the investment. Okay, when you talk of cost of debt, among these three financing, the least expensive is the debt. So hierarchy yan, cost of debt, tapos cost of preferred, and then cost of common stock. This is usually the most expensive of the three. So we're looking at considering the cost that is involved in acquiring these funds. Cost of debt is cheaper, considering that it's even netted against the tax rate. So as I said a while ago, if the tax rate is 30%, then the cost of debt, its contribution to WACC is only 70% of the total cost of debt, okay? And then weight of common stock, and then the weight of preferred stock. Later on, guys, when we go to module 7 or 6 or 7, we're going to study this in greater detail and try to learn how to compute this. Okay, so that reflects the riskiness of the investment and the mix of debt and equity. The riskiness because we have different costs, okay, for the different financing, and the mix is taken care of the weight. Okay, so the weight of the cost of debt, the weight of the preferred stock, and the weight of the preferred common stock. Also, guys, the return should reflect the magnitude and timing of the cash flows. Okay, so let me cite an example here. So suppose we have a project. We have a project, let's call it Project A, and we are told that based on the estimates, okay, so it will just be a four-year project. The initial investment is 1,000. Okay, outflow, cash outflow. For the first year, the return will be 500 inflow. Then second year, 400 inflow. Third year, 300 inflow. And fourth year, 400 inflow. Okay, so these are cash flows, okay? Cash flows, these are not profitability. Okay, these are already the estimate cash flows that we can derive from this Project A. Now, I'd like to ask you a question, guys. Kindly write your answer in the chat box, okay? The question is, should you invest in Project A? Yes or no? I hope everybody shares their opinion or what they think about that question. Should we invest in Project A? So kindly write your answer, guys, in the chat box. Let's have 1 minute for that. So quickly, guys, I hope to get 33 responses from the class. Should we invest in Project A? Okay, so I have one answer. How about the rest, guys? I'm waiting for 2. I hope there are 33 responses here. Okay, so a few more. So there are 16 responses. Thank you so much. So I'm still expecting, I want to have 33 responses. I hope we can have 33 responses from the class. Okay, very good. It's going up. Yes. Yeah, good. So happy with your participation, guys. I really appreciate that. Okay, just a few more. I'm waiting for 9 more responses. I hope everyone in class participate in that question. Just a few more, 19, only 19 left. I mean 9 left, 9 more responses from the class. Okay, thank you, very good. Okay, so let's see, guys. Okay, let's see what your responses are. Okay, yes. Wow, this is consistently yes. Okay. Okay, most of you answered yes. Okay, very good. Okay, so let me see. Okay, let me just call randomly. Okay, Patricia, you answered yes. Why is your answer yes? You may unmute yourself, please. Patricia, Miss Rodis.
Sir.
Yes.
I think the picture, I mean,
Yes, Patricia, you answered yes. What could be the reason why you're saying it's a yes for you?
I think the company will be able to profit from
The project. Could you specify which here in these figures would justify that?
yung one po.
Yung one? What do you mean by yung one?
Yung 500 po.
Okay, remember the initial investment is 1,000. Huh? So kung 1 lang yung titingnan natin, then kulang pa rin yun. No? Diba? Yung 1 to 4, these are the cash flows. No? Year 1, 500. Year 2, 400. Year 3, 300. And year 4, 400. But I get your idea. Okay, thank you, Patricia. Okay, thank you so much for your answer. How about Nike? Nike, you answered yes. Why? Nike? Is Nike here? Okay, let's see. Carl, your answer is yes. Why is your answer yes, Carl? Carl Justin?
Hi, sir.
Yes.
Honestly, same lang sa kay Patricia. I thought na it'd be more profitable.
Why? Could you expound on that? Bakit profitable? If you study the cash flow, ang initial investment natin is 1,000. No? And then first year, ang cash inflow natin is 500, and then 400, 300, 400. Just the practical side, Carl.
Oh, because within the 2 years, at least naka 90% balik
Yeah,
na.
yeah, that's true. No? Carl says that within 2 years' time, we were able to recover already 90%. In fact, on year 3, we were able to recover everything already. It exceeded the initial investment. Okay, that's true. Thank you, Carl. Okay, any volunteer guys? All of you answered yes, but would you want to share why you're answering yes? Anyone? May raise your hand or unmute yourself. Any volunteer?
Sir, I can
Yes,
provide
yeah, thank you. Yeah, Angelo, yes.
Yes, sir. I actually originally answered yes, pero I'm beginning to think it's a no.
Okay.
Kasi from what everyone mentioned, yes, it's profitable kasi in the first 2 years, you're already 90% payoff from your original investment. Pero I'm thinking, since it's good for mga yung long-term investment,
Okay.
pero what if the company wants to have a good mix of its equity and assets? So, pang 2 years is too long for the company. Pang they have to leave their money in their investment for 2 years. Tapos it won't
Okay.
pay them off until the 3rd year. So they're missing out on time where they can use that money for other endeavors.
Okay. Okay. Thank you, Gab. Okay, that's a very good answer. Okay, Gab is saying that we have to take into consideration the mix used, okay, the cost of capital. Okay, that's why, guys. Okay, so I think that will lead us to the answer here. When we look at this 500, 400, 300, 400, I think we discussed this already before. That how do we determine whether this project is okay or not? Okay, the way to determine that, guys, is to compute for the returns of the project. Okay, so that should be very consistent, guys. The return of the project. The return of the project, guys, how do we measure it? we said that the return of the project is measured by the IRR. Okay. So in this case, we were not given the, we were not given the IRR, and neither were we given the WACC. So we can say that we can only answer that if we are able to compute for the IRR. Let's suppose the IRR was computed based on this. The IRR was computed at 12%, example only, and that the WACC was computed at 13%. Okay, therefore, what's our decision rule? Should we invest in this project or not? Answer, anybody? Anyone? The return of the project is 12%. The average cost of capital is 13%. Should we invest in the project?
Hello, sir.
Yes?
No.
Yes, no? Who's this?
Angelo, sir.
Angelo. Okay, Angelo. Yes, why no?
I'm basing my assumption lang based from our last meeting, sir.
Yeah.
Said, it should be, the return should be higher than the capital that we invest.
Yes, that's correct. Well said. Good, Angelo. Thank you so much. That's correct. The internal rate of return of the project should be higher than the weighted average cost of capital. If in this case, the IRR is 12%, the WACC is 13%, then we're going to reject this project. Okay? We have to reject this project because it will not maximize the firm's value. Okay? Sorry, we're here. No? We're here. But we haven't answered yet, guys, the magnitude and timing of the cash flow. We haven't considered that. And that's taken care of by the other measure, which is the NPV. NPV, the net present value. Okay, so how do we answer this? Now, if you take a look at this, 500 plus 400, that's 900, plus 300, that's 1,200. Plus another 400, that's 1,600. So actually, are we able to say that this project is okay because the investment is only 1,000 and the cash flow is 1,600. So there's an excess 600, right? So in that regard, this investment is okay because the cash inflow is 1,600. The cash outflow is 1,000 cash outflow. Therefore, the net is 600. We can look at it that way. Okay. However, guys, take note of this principle. The return should reflect here. The return should reflect the magnitude. Okay, so we're okay with the magnitude. As far as the magnitude is concerned, 1,600 is better than 1,000. However, it also tells us the timing of the cash flows. That's a very important principle, guys. Okay, what does it tell us? We cannot add 500, 400, 300, and 300. 400, I mean. We cannot say that this is 1,600 compared to 1,000. Okay, because that will violate this principle, the timing of the cash flows. What do you prefer, guys? 1 million today or 1 million in 1 year's time? Could I have an answer from you guys? Which would you prefer? 1 million now, today, or 1 million after 1 year? Just say now or after 1 year. Okay, how about the rest, guys? Kindly, I'd like to see your answer. Yeah, of course. Why? Louis, why today? Louis, you said today. Why would you prefer your money today instead of 1 year from now?
Sir, kasi po, hindi na po may iintay. And
Sorry?
may kailangan po gamitin po yung money. So,
Yeah,
mas,
okay.
mas,
Yeah, and if you get it now, you'll be able to invest it, right? And make it earn as compared to getting the money after 1 year. So obviously, guys, we would want the money now compared to getting it in 1 year's time because we can put the money in an investment and then After 1 year's time, the money will be more than, assuming that the return is positive, then it will be more than 1 million. Okay, so that teaches us, guys, that money has cost. Okay, there's what we call the time value of money. Money has cost. Okay, so what we did a while ago, which is to add this 500, 400, 300, 400, that violates the law of the timing of the cash flow. We cannot add them and compare it with 1,000 because they all are obtained in different time frames. So how do we go about that? In order to consider the timing of the cash flows, what we do is, okay, we have to convert how much is 500 1 year from now, how much is it now? The 400, which will be obtained 2 years from now, how much is it now? This also 300, how much is this now? And the 400 after 4 years, how much is this now? So we have to get what we call the present values of each. Okay, so here I have to get the present value of 1, the present value 2, present value 3, and then the present value of 4. We have to get the present values of all of this. Once we are able to get the equivalent value now, so what's the equivalent value of 500 in 1 year's time now? Once we are able to get the equivalent values, then it is safe to say that we can now add these cash flows. And the net of these cash flows is what we call the net present value. So for purposes of example, let's say that present value 1, present value 2, 3, and 4, if we add them, we get 1, we're going to get 1,200. Okay, I'm sorry guys for the small font already. So let's say it's 1,200. Okay, the present value of your cash flows 1,200 minus the investment of 1,000. So the net present value is 200. There. Okay, so we can now add them, the 1,000, the outflow, and all the inflows, okay, which summed up to be 1,200. And the sum that we're going to generate is 200, and it's called your net present value. So the decision rule is that if the net present value is greater than 0, if it's positive, then the project is okay. Okay, so if we do that, guys, we will be reflecting, we will take into consideration both the magnitude and the timing. If we only take a look at the magnitude and disregard the timing, then that will be an erroneous way to analyze your project. So take note, these are all cash flows, no, they are not profits. So how does the company do this? Well, they have to come up with an estimated income statement first. And then from the income statement, we convert it to cash flows. And then the cash flows will be the one used to determine whether the project is feasible or not. Okay? So I'd like to ask a question, guys. Let's suppose this is the situation. The net present value is 200. The IRR is 12%. The WACC is 13%. Question, should we push with the project or not? Okay, kindly chat, please. So this is the situation. IRR is 12% based on our computation. WACC is 13%. NPV is 200. Okay, we know that this decision rule is that the IRR should be greater than the WACC. If it's not, then we should reject the project. And then also, the NPV should be positive. It should be greater than 0. If it's less than 0, then we reject the project. So here we have two conflicting outputs, two conflicting signals. So question, what will the company do? Should they invest in the project or not? So kindly answer, invest or not invest. I hope everybody chats, guys. Okay, let's give ourselves 1 minute to answer that. Invest or not invest? Okay, I hope the others also answer. Okay, thank you so much. Okay, let's wait for the others to key in their answers. Okay, very good, very good. So I hope more will participate and key in their answers. I'm still waiting for the others. Let's give ourselves 30 more seconds. Once again, guys, I hope the others will participate. Let's see, what's the sentiment of the class? Is the class solidly behind a particular answer, or do we get to see mixed answers here? Okay, I hope we have more answers. I just have 13. I'm going to wait for a few more seconds. How about the rest? 20 have not keyed in their opinion or their answer. Let's give them a few more seconds to answer, please. Okay, not invest, not invest, not invest, not invest. Oh, surprisingly, huh? Not invest. Okay, Enzo, why did you answer not invest? Enzo? Enzo Chan, could you kindly share to the class why your answer is not to invest? Which makes sense, no? Because IRR is 12%, WACC is 13%. I'd like to hear from you, Enzo. Is Enzo around? Okay, let's call Jean. How about Jean? Jean Vicencio. Would you like to share with the class why you answered not invest? You may unmute yourself, Jean.
Sir, I'm having connection issues. Oh, wait.
Okay, sige. While we're waiting for Jean, how about Mark? Mark, okay. Hello, Mark. Hello. Okay, any volunteer, guys? Okay, we have 2 participants who raised their hands. Let's see, Angelo, yes, and then we call Josan. Angelo, what did you answer, Angelo?
Not invest, sir.
Not invest, okay, why?
The reason I answered not invest is because what the description is for investment decision, which is the return. You have to earn a return that's greater than the minimum acceptable hurdle rate.
Yeah,
So
that's
just
correct.
it's a positive on NPV doesn't mean just because it meets the minimum requirement, it doesn't mean it's a good investment.
Okay, yeah, thank you so much, Angelo. Thank you for that answer. Now, how about Josan?
Sir, I agree with Angelo. Even if
Okay.
the NPV is positive, it still doesn't mean that it's the optimal choice. And I opted for I looked at the premise of time. 4 years is still, 3 years is still a long time to get back your investment.
Okay, yeah, thank you for those answers. Okay, they're really very good answers. However, guys, we will follow the dictum of finance. No? Now, when we talk of investment decision making, finance is, let's say, dictated by certain principles. Now, number one, we discussed that as answered by Josan and Angelo. This is a no-go because the IRR is less than the WACC, 12% vis-a-vis 13%. So no-go yan. No? Okay, and then NPV on the other hand is positive. So turns out to be okay. And there's a conflict. Okay, now we're going to learn later on, but I'm going to answer this question now. When the NPV and the IRR conflict, when they conflict, guys, the answer is always to follow what? Okay, follow what, guys? Follow always the NPV. Very surprising. Okay, now, okay, the reason why is that when you compute for the IRR, there are certain assumptions there in computing for the IRR, which I'm going to show you when we go to capital budgeting. We make certain assumptions in computing for the IRR, which may not be that realistic, quote unquote. So in terms of the soundness, the theoretical soundness, NPV is the more theoretically sound way to compute the return of the project. So when there's a conflict between IRR and NPV, always follow NPV, the net present value. Okay, but I appreciate, guys, your answers. They're very, very good answers. Okay, but however, we will follow the dictum of finance in that NPV is always the better choice in determining whether the project is feasible or not. Okay, oftentimes, guys, they agree with each other. But in cases where there are conflicts with the choice as to the feasibility of the project, viability of the project, then always follow the NPV. Okay, guys, is that clear? Okay, we will suspend the discussion of the theoretical background on IRR and NPV. We'll discuss it when we go to capital budgeting. Okay, but suffice it to say, guys, now you know, guys, that the NPV is the more theoretically correct way to compute for the viability of the project. Okay, so in this case, the answer is yes, we should invest. Notwithstanding the fact that IRR is saying that we should not. But the net present value is greater than 0, then this project should be a go. Okay? May I have your chat, guys? Kung very clear ba yun siya? Okay, is that clear, guys? Is that concept clear? That when the IRR and the NPV conflicts, always choose the NPV. Okay, thank you so much. Good. That's very good. All right. But nevertheless, guys, thank you for your contribution. Thank you for your answers. It makes our discussion really, really robust. And I appreciate those. Who take courage to give their answers. Okay, I noticed that, guys. I will keep that in mind. Okay, so pag nagpa-participate kayo, of course, I'm not. I know who are the ones participating. Kaya thank you so much. All right, so that's the investment decision. Then we go to financing decision. Sabi natin, the right mix of debt and equity to fund the operations. Okay, so should it be 70-30? Okay, it depends on really what's the optimal capital structure of the organization. The optimal mix of debt and equity should maximize firm value. So we said the right mix and the right match. Okay, the right mix is that the balance of the equity and the debt should maximize shareholder value. The right match should be that long-term projects should be financed by long-term financing. Short-term project or short-term investment, short-term assets should be more financed by short-term assets. Sometimes can be a mix of short-term and medium-term or long-term assets, but mostly short-term also. Okay, so this is very clear as far as the financing decision is concerned. Okay, then we go to the dividend decision. Okay, if the firm cannot find investments that are higher than the hurdle rate or the WACC, then it may decide to return the cash to the owners of the business. Okay, now the question is how much, okay, how much cash should the company return? Well, it depends on the current and potential investment opportunities. Maybe now there are no current investment opportunities, but the company foresees that in the next future there will be other investment opportunities. Okay, so this is again a very important decision that finance has to make. Okay, so should the company return the cash as dividends, or should they buy back the shares of stock, which we call buybacks or treasury shares? And there are reasons for doing this, guys, the treasury shares or buying back their shares of stock. And then we'll discuss that in greater detail in the future, because this is already an advanced topic. Okay. Yes, there will be the company should return the capital, but should it be in the form of dividends, or should the company buy back the shares of stock of the investors? So three very important decision making, all with the intent of maximizing the shareholder value of the shareholder value or the value of the business of the firm. So whether it's investment, financing, or dividend decision making. Okay, so we looked at this. The finance function involves investment, financing, and dividend. By the way, guys, since we're going to complete these slides already, I'm going to post this after class. Okay, so maximizing the value of the firm in whatever decision making. Okay, so there are some corollary principles here. Okay, there are 5 of them. Number 1, cash flow is king. When we compute for the viability of a project, it should be based on cash flow computation, not profit. Okay, so how are cash flow computed then? Well, we estimate the income statement, and then whatever the bottom line is net income after tax, we have to convert them into cash flows. Okay, second principle, the time value of money. Money has cost. 1 peso today is worth more than 1 peso 5 years from now. Then also the principle of risk and return. The higher the assumed risk a company is taking in, the higher should be the required return. And also the market forces, this is what we call the efficient market hypothesis, the EMH. And lastly, we have the agency problem, which we have been discussing the past several sessions. Okay, so let's take a look at this quickly one by one. Okay, and as far as this principle, corollary principles is concerned, in terms of cash flow, okay, the bigger the amount of cash flow, the bigger the expected amount, the better. In terms of timing, the sooner the cash flow is obtained, the better. And also in terms of the nature of the cash flows, the less risk there is to the attainment of obtention of the cash flow, the better. Okay, bigger is better, sooner is better, less risk is better. So let's take a look at them one by one. Cash is king. That's principle number 1. So what does that mean? We cannot equate accounting profit with cash flow. There's a difference between accounting profit and cash flow. We said that cash flow is paramount. It's what fuels the economy. It's what makes the operations of the business go. Liquidity. Okay, and why is this so? Because investors, creditors put in cash in the company. So investors would require cash back in return, whether it be creditors or shareholders. Okay, it's cash flow that drives the value of the business. Okay, and then here we see incremental cash flow needs to be determined in making financial decisions. We'll discuss what incremental cash flow is. So when you say incremental cash flow, we're just netting whatever inflow and outflow there is. The net is called your incremental cash flow. So for example, you're going to, a case in point is you're going to replace, let's say, an old equipment with a new equipment. So when we talk about incremental cash flow, you will have to look at the cash flow to be generated by the old equipment, and also the cash flow generated by the new equipment. Okay, since if you're going to replace the old equipment, you will be losing on the cash flow to be generated by the old equipment. Okay, and instead you will have the cash flow to be generated by the new equipment. So when you compute for the cash flow, you should subtract the cash flow to be generated by the old equipment. So let me just write down. So for example, we have this old equipment, and we have this, we're planning to buy this new equipment. Now for this old equipment, you have also cash flows. Okay, for this new equipment, you have this estimated cash flows. When we talk of incremental, okay, when we talk of incremental, you're not only going to look at the new cash flow, you have to subtract the cash flow old. Okay, because this is what we call opportunity cost. Because we're going to buy the new, then we are foregoing of this old. Okay, so the net, guys, will be your incremental cash flow. So that's very important, guys, when we take a look at cash flows. Okay, now next, time value of money. Okay, as I said, guys, only for this chapter 1, I'll be doing more of a monologue. But when we go to chapter 28, guys, it will be more hands-on. Okay, time value of money. What did we say? 1 peso today is worth more than 1 peso in 5 years' time. Now, money earns interest, and interest is money. So interest can also earn interest. So there will be interest on interest. Okay, so thus it's better to receive money now than 1 year from now, because your money now can earn interest, and then the interest, since it's also money, it will earn interest also. So there will be interest on interest on interest. So that when we go to after 1 year, then you'll have more money as compared to getting your money after 1 year. Okay, the risk and return principle. Okay, no company, no creditor will be willing to take on additional risk without being compensated for it. Okay, if there's an additional risk to be had, then the firm should require additional return for that. Okay, let's take a look at the case, guys. Globe, it's a Globe and Dito. Okay, Dito is relatively new. Globe has been there in the market for several decades already. So let's suppose they need 100 million cash. Okay, they're going to invest. They need this 100 million cash, and then they're going to issue bonds. Okay, a bond, guys, is a utang, no? It's a promise to pay, long-term to bond. Parang Globe and Dito is promising that they're going to pay the interests every year. Let's say monthly interest. No? Suppose that it's a monthly payment, 10 years. So the same, guys, 10 years in Dito. Okay, monthly also, monthly payment of interest. Okay, question. One company issued a 7% bond. Another company issued a 7.2% bond. Okay, question. Which company issued the 7.2% bond? Would you kindly chat, please, in the chat box? Which company issued the 7.2% bond? Okay, ceteris paribus, all things being the same, guys. Which company? Okay, Dito, thank you. Angelo, who else, guys? I'd like to see the others answer. So for Angelo, it's Dito. How about the others? Which company issued the 7.2% bond? I'd like to see the response of others, please. Josan, thank you. Jean, thank you. Amy, thank you. Carl, salamat. Okay, Patricia. Okay, very good. Very good. Guys, your answer is correct. Okay, it's Dito. Why should it be Dito? Because, guys, any creditor, of course, due diligence will dictate that since Globe has been in the market for a long time already, track record niya as far as paying credit is concerned is much better than Dito, who is a relatively new company. So taking asking the question, in which company will the creditor assume greater risk? Is it with Globe or is it with Dito? The answer is the creditor will assume a greater amount of risk with DITO. So since if it's going to lend DITO, it's assuming a greater amount of risk, then it should only be willing to lend money if it's to be compensated for the additional risk. So you're correct. It is DITO that is issuing 7.2% bond. Otherwise, guys, if pareho lang silang 7%, then DITO might find it difficult to borrow money. Kasi pareho silang, both of them need 100 million payable in 10 years, monthly yung payment na interest. And yet, we know that Globe is less risky relative to DITO. So if I were the creditor, why will I lend to DITO if it's only giving me an interest of 7%? Okay, in terms of performance, in terms of track record, Globe is the better company. Okay, so I will only be willing to lend to DITO if I'll be compensated for the risk, additional risk that I'm assuming. Okay, I hope that's clear, guys. Okay, so we go to 7.4. Market prices are generally right. What does this mean? Okay, let's discuss this very quickly. Now, when you trade in assets, whether it's stocks or bonds, the market should, the prices in the market should reflect all available information. We call it the efficient market hypothesis, okay, EMH. Now, there are actually 3 types of EMH. I would want you to explore this, okay? What are the 3 types of efficient market hypothesis, efficient markets? Okay, I won't answer that. Maybe in the quiz, in the long quiz, that will come out. I want you to research about that. Now, why is it important that markets are efficient? When we say efficient, the information should reflect, the price should reflect all available information. Okay, because if it's if the prices do not reflect all available information, it means that there are only some privileged group of investors who have this information. And if only some have this privileged group of information, then the market will not really flourish. People will be afraid to invest in that because there are others who are privy to more information and are able to use this information to invest. So hindi pa pwede yun. Okay? Market information has to be present to everybody. Okay, and the stock prices is a good indicator that the stock prices is a useful indicator of the value of the price. Technically, guys, the price of the stock that's reflected in the market is actually not equal to the value, the worth of the stock. When you say price, it's how much an investor is willing to pay for that asset. When you look at the value, it's the intrinsic value. Okay, so sometimes there's a mismatch between this, and this is what investors work on. So for example, if they computed for the what we call the intrinsic value, kunyari, the intrinsic value is 50 pesos. So they were able to compute using valuation methods, and they found out that the worth of the asset is 50 pesos, and the price is selling at, and the stock is selling at 48 pesos per share. So that means that the stock is undervalued, okay? Because in the market, it's selling at 48, when in fact, the actual value, the worth is 50 pesos. So the decision here is that invest, buy that stock, okay? Buy that stock, because the price of the stock is undervalued. Again, the price is the amount by which it is being traded in the market. And usually, if in a very efficient market, usually the price and the value are usually very close to each other. But sometimes, because of anomalies, they can be different. Okay, so if there's an inefficiency, then there might be distortion in the value. And if there are inefficiencies, then that can be grounds for investors not to trade in that market. Okay, so for example, let me show you guys. Okay, here, this is the, okay, this is the, ito guys, ito yun, no? investing.com. I shared with you that site. Okay, if you take a look at this, so you see, guys, all the prices here. Okay, so this is the PSA, the Philippine Stock Exchange Composite. Okay, Aboitiz Power, Ayala. So this price of Ayala here, the 869, reflect all relevant market information. Okay, that's very important for a market to be robust, for the market to be trusted. Okay, because if there are quote unquote hidden information, and this hidden information are only available, let's say, to brokers, and nobody will trust the market because there are a privileged group that have access to that information. Okay, and remember, there were instances in the past that there were what we call insider trading. Yun ang delikado, no? Insider trading is that when there are certain parties, there are certain groups that become knowledgeable about particular information, and they're able to use that information to benefit from the market. Okay, insider trading will make investors lose trust in that market. Okay, so these are the stock prices, and the assumption is that in an efficient market, the price here reflected is approximately equal to the value of the stock. Okay, the price, which is a good barometer of the value of the stock. Okay, so that's what we mean by efficient markets. And it's time, guys. So let me just end in this. And lastly, the conflict between agencies, the agency problem. Okay, so guys, may I have your permission? Just 2 minutes, guys. Okay lang ba? Could you kindly chat? It's already 12:30, and may I have just 2 minutes just to finish the last 2 slides? Okay, thank you so much, guys. Now, I just want to mention, guys, for agency problems, we have what we call agency problems, guys, because sometimes the managers might not do things that are beneficial for the shareholders, but for their own selves. So that's what we call agency problems. So one good way to address this is there are other ways. Is what we call the employee stock option plan. Okay, so what's this? The employee stock option plan. This is an option for the employees to buy the shares of stock of the company to make them also shareholders. Okay, and usually it's a price that's discounted. Okay, so if the company does this, then the employees are not only employees, but they're shareholders also. And if they're shareholders, guys, it will be more difficult for them to do things that will destroy the company, okay? Because they have an investment in the company. They have a stake there. Okay, so last 2 slides, guys, this month. Corporate finance is common sense. Okay, nothing earth-shattering about investing in 12% when the cost of funds is 11%. Okay, di ba? Hindi naman rocket science yan eh. Na mag-invest ka lang if the investment, if the return is greater than the average cost of capital. Okay, also it's common sense to try to find role of finance, to try to find a funding mix which is 12% instead of 13%. The cheaper the cost of financing is, the better for the company. Okay, also it's common sense to say if the company is able to generate returns less than the cost of financing, then better to return the cash to the owners of the business and shrink the business instead of just parking the money with the company. Okay, it's a lot better to return the money as dividends because that also sends a strong signal. Aside from being common sense, guys, finance is also focused. What do we mean by focused? Because this objective is singular, which means only maximize shareholder value, not to maximize customer satisfaction, not to maximize supplier satisfaction. Singular main objective, guys, main objective. I'm not saying that satisfying customers is wrong, but the main objective should be to maximize shareholder value. So what does it mean? If there's a singular objective, it means just choose the right investment. Okay, given several investments, which is the best one? The best one is one that has the highest IRR greater than WACC or the highest net present value. Determine the right mix. It's always right investment right mix of debt and equity, right amount of cash that should be returned to the shareholders, right investment, right financing, right dividend decisions. Thirdly, guys, it is universal. Corporate finance is universal. So whether it's a big firm, small firm, public, private, mature market, emerging market, these three principles on investment, financing, and dividend remains true. Okay. The objective remains true that it should be to maximize value, whatever the decision making is. And lastly, it is universal also. Okay. So whether it's publicly traded or private, guys, the decision is still to find a financing mix that minimizes their cost of capital. The reason why this is very important is that, okay, ganun din dito, guys, ano, whether it's emerging market or the developed market, okay, ganun pa rin. Yung returns dapat ng investment should be greater than hurdle rates. So in what type of business, guys, it's always the same. The reason why this is very important is because the firm, I want you to read on this, the VUCA principle. Any firm now faces this volatile environment, uncertain, complex, and very ambiguous environment. Okay, so with that, guys, we end our discussion. Thank you so much. I'll stop now.